Hello, everybody. We are a little bit late on getting this update out there, but it is a really important update because I think I want to talk to people about some of the things we're hearing about out in the marketplace, some of the things that we are seeing out in the marketplace, and how that might affect you if you're either a buyer or a seller in Southern California market. Once again, for us, for our stats, we define the Southern California market as Orange and Los Angeles counties. So we're going to go ahead, kind of get into our weekly stats here. I think it's important to kind of note a couple things just before we launch into there. One is that this is one of those weeks where we have a little bit of conflicting information, or we have information that's pointing in one direction, but we also have kind of a piece of knowledge that might be biasing some of those figures. So want to talk about that a little bit because I think it's important to kind of note these caveats. I think people, because they want to deliver you something clear and they want to say something like, the market's crashing, the market's booming. Well, honestly, the market's a bit more complex than that, not only based on what sort of price range you're in, which is why we divide things up into price range, but also based on geographic area and even individual market segments. Sometimes, you have these market segments that are super hot, like architectural properties in a particular area in Orange County. There aren't a lot of them. So when they come up, people have a little bit of extra money, interest rates are low, they're willing to splurge. That's a very hot sort of submarket at the moment. Anyhow, let's get into the stats. We're going to launch into that, and I'm going to talk to you about kind of what I am seeing, and we can go from there. All righty, so let me back these up here. All right, total active listings. So we have a little bit of a click tease here, but it isn't a tease, it's real. Inventory has jumped, and I want to talk about this. I mean, this really is a level of under $1 million inventory that we have not had at all since the beginning of the year. I mean, this is significantly higher, and I want to take some note of that. We have the same situation here down on $1 to $2 million, or $1 to $2 million price range. But before, if you're a buyer, before you crack the champagne and pop those corks, I think it's important to understand that I think some of these numbers are a bit skewed by timing. And here's what I mean by that. So we do a look back of 14 days on some of our statistics. Not that that matters for total active listings. This is a snapshot. But one of the things that's interesting about this is that we recently had a holiday weekend. And I think I've talked about this in previous videos. One of the things that happens at holiday weekends is that buyers in the hot market tend to keep buying, and sellers don't put their houses on the market. Instead, they wait until the week afterwards to start putting those houses on the market and going through. And I think a little bit of this number might be a result of people who put their homes on the market in the last 5 days. So I don't think that explains all of it. I do think inventory is up in our under $1 million price range. I don't know if it's quite this blockbuster figure that we're seeing here. And in fact, next week we'll kind of see, does this number back down to maybe a number that's more like here or up here. Still a high number, but not quite as high. So I'm kind of curious about seeing whether that happens. And I actually think there's a couple of reasons that this inventory number will back down, and I'll talk about that in a moment. So, I'm a big fan of the fundamentals of supply and demand, right? This is real estate. It's not rocket science. And I think a lot of times people, they try to make these things and rationalize and intellectualize things. But the fact is, at the end of the day, this is a market and it responds to normal market forces, at least as its primary method of response. So here's something interesting that I think really does shed a little bit of light on things. So this is our last 14 days of new listings, and I want to walk you through this. This means this covers the period both before and after the 4th of July, whereas last week we were only covering the period before the 4th of July. So if you looked at that, you saw this bump down that we talked about, right? That is because people hold off on putting their home in the market, and then what do? They put that home back on the market the next week. But here's something that I actually think is kind of interesting, right? This still covers some of that before week. We didn't fully get back, meaning for all the people who didn't put their home on the market before 4th of July, that number of people didn't immediately come back, right? I mean, this number is here. It's not up here. It wasn't a we lost some the week before and we gained some extra the next week. We lost a lot the week before and we gained some of them back the next week. So that's kind of an interesting thing, seeing that that supply is not necessarily where we would expect it to be. Now, the flip side of this is demand, right? And again, for the demand, um, you would have expected things to even out. What I'm seeing is a little bit of an easing. It's less noticeable here in this $1 to $2 million price range, right in line with the number of homes that normally go. But the last 14 days of houses, to go under contract under $1 million, that number is down maybe about 7% of where we would expect it to be. And I mean, we are entering a vacation period. This is pretty normal. I'm gonna go off screen share here. Um, our Southern California market has kind of some weird timing intricacies. So if you live in the Midwest, this is how real estate works, generally speaking. Um, as soon as the flowers start blooming in spring, that is the hot season all the way through August. And then it cools off because people are going back to school and the weather turns and the market just generally cools quite a bit. A lot fewer houses come up, a lot fewer houses sell. And through the dead of the winter, nothing happens. Our Southern California market is a little bit different than that. We don't experience that same kind of weather seasonality, at least not in most markets. Laguna Beach, some of the coastal communities, they're a little bit more seasonal. But for the most part in Southern California, yes, the spring and summer are busier, but it's not an all or nothing. In other markets, I mean, it's like off by like 70% in the off season. We don't really have that kind of an off season here. What we do have here is kind of an interesting trend, right? Where people start taking vacations and their mind starts being off of things. So typically for us, middle of July through August are not great, and then the fall is actually better in Southern California market. So this is not at all a typical market. So I'm really curious to see whether that's going to hold true this year or not. We'll have the graphs to prove it, so we'll be able to see. All right, so jumping back in here. Again, this decline is kind of interesting because we saw, we see that 14-day new listings, that's also not really at the level that it's been at. It really hasn't been, unless you're counting our 1 to 2 million. And our level of new escrows also went down. So it's kind of interesting to see both of those move at the same time. Now, if we go to our absorption rate, this is kind of really where there's kind of a big story. And I want to make sure I'm not confusing things, right? Like this level of absorption rate, right? To go from like a 90% and over to an under. I do think part of this is a little bit of this seesaw timing effect that we saw, right? Like we had way more buyers than you would expect leading up to 4th of July. And now we have fewer buyers. Again, this is a 2-week look back. So this does cover that before and after period. I still think that this absorption is a little on the weak side. But I also want to mention this is high 70s for under 1 million. This is still considered a seller's market by anyone's definition, right? I mean, that easier is not the same as easy. Though, it does strike me, this is definitely a low point that we've seen really since towards the beginning of this year. And same thing here over in our 1 to 2 million, just a little bit over 70%. Still, in my opinion, a seller's market, but not quite the craziness that we've seen. I think some of this, like I said, is this holiday-induced timing effect, but I'm not exactly sure. So now for our closed prices. Again, I repeat this every time. People still ask me questions about this. This is a look back of houses that were negotiated, 4 to 6 weeks ago. This is not homes that were negotiated yesterday, because really that's really what sets the price. Is it's when you're writing offers and you come to an agreement. It's not when the house actually closes, in my opinion. We're still looking for a proxy to get pricing data that's a little bit more up to date, but look at this trend that shows up in all 3 of our pricing categories. Sort of this crest and then a fall and then kind of a bounce off a little bit of a relative low. Rise, fall, bounce. rise, fall, bounce. Now, obviously, what price range you're in kind of dictates the severity of the rise, fall, and the bounce. What I think is interesting is look who's the strongest in all this, though. Who had the biggest bounce is actually the median level. That's sort of 800,000s, 800,000s range, had the strongest bounce of anybody. I think that's kind of the bread and butter price range. These are the buyers who they have enough money, right? Like these are people that are probably not right up against their pre-approval in most cases, unlike first-time home buyers who are very interest rate sensitive, or luxury buyers who might be more economically sensitive, right? Like they may be more concerned, like, is now the right time for me to make that luxury upgrade home purchase? So this is another piece of information that we've started doing. And, I think what's remarkable about this is just how high this number is. Now, again, I think there's a reason this might be holiday skewed. So the way we calculate this is we look at all the homes that came on the market in the last 14 days. So that'd be the very end of June to July 13th. So we look at all those homes, and we look at what percentage of them are still available. Well, and the reason why I think this might be a little bit skewed is if you were waiting to put your home on the market before the 4th of July, and what you did is you put it on the market in the last week, right? This is going to skew heavily towards homes that just hit the market this week. And that kind of might throw this number upward. I still am not sure. Look at the range we were in. And I mean, we just jumped out of the norm range on both of these. I don't think that's entirely explained by the holiday weekend. So I think one of the things we're trying to do when we look at stats like this is we are trying to deduce the components of something. I'm going to go share here just for a second. So any statistic that you use in the market is really a combination of variables, right? Like, here's a good one. How many houses went into escrow last week? Okay, here are the variables that go into that. Well, how many houses were available, right? If there were no houses available, then there would be no new escrows. What did interest rates do? Was there a holiday weekend where people couldn't look at houses? Like, I mean, we're adding up these components, and what we're trying to do is we're trying to decide how heavily do we want to weight those components to try to get an idea of what's going on, right? Because we're trying to look under that hood and be like, hey, this number did this. Why? What are those underlying things changed to produce that result? And it's not always easy. And there's kind of a lot more art than science to this. And I think that's something that people fail to understand. They think numbers are numbers, but that is actually not always true. So I think a part of this is holiday related, but I don't think all of it is. And that makes me wonder, are we kind of heading towards a little bit of a July slowdown? Are we seeing sellers kind of jump into this market with just ridiculous prices, and buyers are finally hitting sort of a bit of a breaking point, saying enough's enough, I don't want it that badly? Is there that level of buyer fatigue going on? I think some of those might all be true. Okay, moving on here. This one, though, is the one that I am sort of very, very interested by for a couple reasons. Number one, it's not normal to see our close to list ratios move in different directions like this. Like if you look here, they typically move kind of in unison. There's a couple exceptions, and one of those exceptions is this week. This list to close ratio shot up for our 1 to 2 million, but kind of petered out a little bit. And something that I've talked about as an agent on both sides, I don't like this arrangement where our closing prices are significantly different than our list prices, because that means there is a very big disconnect between expectations on both sides. I think you are in a much healthier market when those expectations between buyers and sellers are more closely aligned. I think that's a more honest market. It's a more transparent market. So, my hope is that we're going to see this kind of drop down a little bit, maybe somewhere in this 100 to 102% range. That still says active market, busy, homes are desirable, but it doesn't say sort of like crazy circus bid whatever to get it market, because like I said, I think that's not a great place to be in the long run. This is another piece of data that I kind of found fascinating. This is our days on market for new contracts. These are contracts that were signed in the last 14 days, right? What was was our days on market for those contracts. And, we saw a number go up to 20 days here for our under 1 million. That's still well within the range. We've kind of bounced off that 20-day number, kind of in this 17 to 20 days. Not really a huge change. And I'm curious to see what's going to happen next week. But this is out of the ordinary in our $1 to $2 million range. And it makes me wonder, are we seeing a sea change in that upper end of the market? I mean, look at what just sticks out like a sore thumb is this number here. And I'm very curious to see, is this the new normal that we're in a higher number like this, or is it going to back down again? Again, entry-level homes under $1 million, not out of the range really. I'm curious to see what happens next week, but this number is unusual to me. This sticks out. We haven't seen this kind of a jump really, and we haven't seen this kind of a number since all the way back here in March, which seems like a distant memory. Okay, affordability, right? And one of the things that I talk when I talk to people about the housing market and sort of my level of concern, are we overheated? Are we inflated? To me, affordability really is kind of the king number in all of this. And again, this is based on homes that have just sold, right? Or just closed, which means these are contracts from 4 to 6 weeks ago. Interest rates did drop this week, by the way. But when we look here, I think one of the things I've talked about is that we really want to be in this 110 to 120% range versus payments in 2018. So that's what this chart is looking at. If 100% is where the payment on a median priced home was in June of 2018, this tracks relatively where are we. I like to be in this range. I think this range is in line with inflation and wage growth since that period of time. I think this is a number that feels safe when we're in this range. If we start to jump up to 125, 130, well, that's the point where I start getting more concerned. And if we go above 130, then I'm going to be real worried, because I'm going to think we don't have wage growth to kind of support that level of increase in median prices or in median payments, right? I know I say all this all the time, but home prices, interest rates don't matter. They really don't matter that much. What matters to consumers is, can I afford the payment? That is how consumers make buying decisions when it comes to homes. I mean, there might be some caveats to that, right? Like some people might evaluate things, but that is the primary consideration when consumers talk about affordability. And that's the reason why we track this so heavily, because that's sort of my warning indicator, my canary in the coal mine that things are going not well, right? And what we might start tracking, because I think it's important in this market, is tracking the rental of a median single family home as well, and tracking how the median payment relates to the median rental. Because at the end of the day, that's really what most consumers are deciding. What kind of a premium are they paying on housing versus renting? And is that a premium that remains constant over time? And if you watched our other video about bubbles, you'll notice that is true, that is largely, there's been a constant relationship or a very similar relationship over time. And it's the only time we've ever really been in trouble in markets is when that relationship gets extremely out of whack. Anyhow, I know I also mentioned this already, but if you look here, prevailing interest rates on a 30-year fixed rate mortgage, and we very nicely went down to 2.9% this past week. Yay. Great news for buyers. Actually, great news for sellers too, really, when you think about it, because this enhances what they can buy as their next home, and it also, enhances, the ability for buyers to pay more for their home as well. So, again, I apologize for being the next morning. We wanted to get this stuff right. Obviously, questions, comments, we love them. Kind of a real interesting point in the market. I kind of feel like things are a little shaky, and we had a holiday week, which just screws up the stats. It kind of makes them a little bit difficult to see how much of that is holiday weekend and how much is actual changes. Questions, comments, we love them. Do not forget to like, subscribe, and hit that notification bell if you are watching us on YouTube. And if you are watching us on YouTube, you should subscribe to our YouTube channel as well. There's a link below. As always, if you are thinking of buying or selling in the Southern California area, we would love to work with you and love to help you and give you some additional insight on the market strategy and your decision-making process. Definitely reach out to us and we'll be happy to help. We'll see you later on this week for our first-time home buyer market update as well.